Okay, our next module for derivatives, benefits, risks, and uses. And our first learning objective down here, describe benefits and risks of derivative instruments. So we'll start with benefits, and yeah, the screen is intimidating, right? There's a lot of charts up on the screen. But it helps make the point quite clearly about the benefits. So we have risk allocation, risk transfer, and risk management. And when you start to think about them, you may say, but aren't those all the same thing? And we can achieve all of this all without trading in the underlying, just using derivatives. So let's talk about risk allocation. When we design an asset allocation, what we're saying is we would like to allocate some of our money to this, some of our money to that, etc. Well, can derivatives do that? Can we achieve an allocation without actually buying the underlying? Which means we want to gain a risk exposure. So we have something like this. What do you see here? What kind of payoff do we have? We got nothing. We got nothing. To something like this. As the price goes up, we start to gain. As the price drops, we lose. Just the same as owning a stock. If you buy a stock and the price goes up, you gain. If it drops, you lose. Well, you can do that with the derivative. You can go from nothing to something. You gain a risk exposure. So when we talk about risk allocation, it means we are allocating some money to owning some risky asset. Let's talk about risk transfer. And this is what you're doing when you buy insurance on your vehicle, is you are transferring the risk of any damage to your vehicle or any damage to the public to the insurance company. That risk still exists. You still may get into an accident. You still may damage your car, but it's somebody else's problem now. So this is either to hedge or offset some or all of your risk. You don't have to get rid of all of your risk. A good example is, let's say you have a portfolio of $100 million and it has a high beta, a beta of 1.2, and you expect market weakness in the future. Well, you don't want to go to beta equals 0. You might say, well, let's get our beta down maybe to 0.9. But you don't want to sell any of the positions you have. You can use futures contracts to lower the beta of your portfolio. So as the market weakens, your $100 million position would drop in value, but your futures contracts would gain in value, thereby offsetting some of your loss. You're not completely hedging, you're just offsetting. So here's a hedge. Let's say that we have positive exposure. We know this is positive exposure because as the price goes up, we gain. Well, we can add negative exposure. So we can add a derivative that as the price goes up, we would then lose. Why would we want to do that? We would want to do that not because we think the price is going up, but we have some positive exposure that we want to keep. And we think the price is going to go down, so we might lose. Well, here, if the price goes down, we gain all without having to trade the underlying. And if we take our positive exposure and we add some negative exposure, look what we end up with. We can end up with nothing. Even though we haven't done anything, we can get rid of all of our risk by using derivatives, some or all of our risk. And what about managing risk? Well, let's say that we observe a return distribution for a particular stock, and we know that a return distribution, that the returns, the continuously compounded returns are distributed normally. And here's our expected return on the stock. Here's the distribution of the returns. And we may say to ourselves, yeah, this is the expected return. I don't see this happening. But when I buy the stock, I'm basically buying the entire return distribution, but I don't see this happening. Is there any way that I can get the stock cheaper if I say to the seller, look, I'll buy the stock, but I don't really care about any of this? Well, not really, but we can use a call option. We can take this part of the distribution and we can sell a call to somebody else. So we have a long stock position, we have a short call option, which gives us a payoff that looks like this. We'll earn up to a certain point, and then after that, the stock gets called away from us. We're going to sell a call with a strike price that is above the current stock price. Anything above that price belongs to somebody else. It gets called away from us. But we had the belief that, you know what, I don't think it's going to get there. Now, we also may say, I'll buy this stock, but I don't want this part of the distribution. Well, in this case, we would buy a put to get rid of that risk. And we just have the upper part of the distribution, maybe a little bit negative, but for the most part, an upper part on the distribution. You can also allocate or transfer risk across time. So let's say in 30 days, we know that we're getting a big pile of dividends in from our portfolio. But we would like to get exposure today rather than wait 30 days for the money. Well, we can use derivatives to get exposure today, knowing that we will have the money to take delivery in 30 days. So we can sell puts on stocks that we want. We can sell in the money puts in the hopes that in 30 days the stock will be put to us. And that means we are actually buying it on this day. And if we sell puts, 30-day puts, we will actually get the stock cheaper than what the spot price would have been, because there'll be a time value component to the in-the-money put. We can also go long equity index futures and then close our futures out on day 30, take whatever gains or loss we have, use our dividends, and then buy the underlying basket of stocks that we wanted. Second benefit, information discovery. You may not be aware, but futures trade on an index called Globex, not on an index, sorry, an exchange called Globex. And this opens, depending on your broker, Sunday around 6 p.m., Sunday night at 6 p.m., all the way to Friday at about 5 p.m. And it does shut down during the course of the day between 5 and 6 p.m. Mondays through Thursday. It shuts off at 5 on Friday. And you can trade futures on oil, natural gas, the metals, gold, silver. What else is trading? Equity index futures. The big one is the S&P 500. You can trade futures on the S&P 500. Well, how would they change in price if the spot markets are closed? We know, or you will see, that a futures price, if we calculate a futures price, is nothing but the spot price carried at some interest rate over some period of time, and not just some interest rate, but maybe there's some costs and benefits as well, called the cost of carry. It is a function of the spot price. Well, if the spot market is closed, the spot price, if you look at a chart, would be going, let me do this better, would be flat. So how is the futures price moving? The futures price will move based on what the market feels the cash market will open at. So that when the spot market does open, when the stock market opens at 9:30, it is expected that the futures price is a good predictor of where it's going to open. Once it opens, the futures price will track the stock price, but after hours, the futures price will respond to information. That's where we get information discovery. Derivatives, primarily futures, can trade outside of cash market hours, and they can signal where the cash market will open. Futures on equity indexes, on commodities, and on bonds, U.S. Treasuries. They can also signal market belief. So there is a federal funds futures contract. You'll see this at level 3. And it will begin to price in where the market thinks the federal funds rate will be at that point in the future. Some operational advantages: reduced cash outlay. If I want to make a bet on the price of oil, CL at $108 a barrel would cost me $108,000 to get 1,000 barrels of oil. Well, I only need a margin requirement roughly of about $8,500 to get that done. So reduced cash outlay, lower transaction costs because it's one futures contract. Imagine buying 1,000 barrels of oil and storing it somewhere. You got to put it somewhere, right? You got to pay for storage. So lower transaction costs, especially when it comes to commodities. You eliminate transportation and storage costs. Now, I say that you eliminate them. We will see that that's not really true. You eliminate having to pay them up front, but you do not eliminate the fact that you must pay for storage and transportation, simply because it will be in the futures price. So if oil, the spot market for oil is, let's say, 107 110 and you're looking at a 30-day contract, it may be 108 even though the spot market's at 107, because the difference between this is what it would cost to store a barrel of oil, what it would cost to borrow money, buy a barrel of oil, and store it for 30 days. That is what is in the futures price. So it eliminates you having to pay for it up front, but it does not eliminate the cost of that. We're going to see that in a module coming up. Still with operational advantages here, increased liquidity. In some cases, increased liquidity versus the cash market. And this is as a result of much lower capital requirements. Increased liquidity, especially with commodities, and that you don't have to deal with the underlying to take a directional view on commodities. And commodities added to a portfolio can be a good inflation hedge. It's not always true that the derivative will have greater liquidity than the underlying, especially if the underlying is already publicly traded. For bonds, yeah, typically the case at derivatives, especially when you get to the off-the-run treasuries or something other than U.S. treasuries, the derivatives typically will have more liquidity than the underlying. But that's not necessarily true of some other underlying, such as DuPont, if we take DD. Very liquid stock, very illiquid options, wide bid-ask spread between them. And when we talk about liquidity, you can get a rough measure of liquidity by the distance between the bid and the ask. The further apart they are, the less liquid it is. The tighter they are, the more liquid it is. The ability to short, and this is especially for commodities or anything that is not publicly traded that would be an underlying. Gold is not publicly traded, it's physically traded. However, there are instruments that allow you to publicly trade gold miners, an ETF that holds physical gold, and of course the price of gold with derivatives. It's a lot easier to acquire 100 ounces of gold in the futures market than it is to acquire 100 ounces of gold in the physical market. And market efficiency. It's less costly for arbitrage when you have a futures contract and an underlying, and because the futures contract is a function of the spot price, when they get out of line, you can buy one, sell the other until the arbitrage opportunity disappears. Risks. Greater potential for speculative use. Well, anytime you have something that is traded, you're going to have investors, you're going to have hedgers, and you're going to have the speculators. The speculators sometimes treat the market as just one big giant casino, and this is just another table to sit at and, make your bets. There is a high degree of implicit leverage in a futures contract. Let's just have a look. Again, here's CL, $108 a barrel. The whole contract is $108,000. You can control that for $8,500 margin. That's 12.7 times leverage. That is huge. So let's assume that the price of oil changes by $1 up or down. Since it's $108 a barrel, a $1 change is 0.926% change in the price of oil. But since the contract is for 1,000 barrels, a $1 change is a $1,000 change on your $8,500 margin. I've got absolute, this is the absolute value we're looking for, is 11.76% gain or loss. So even though the price of the oil itself only moved less than 1%, your gain or loss is 11.76% because of the level of leverage. People who are new to this market don't quite understand the amount of leverage they have. Now that's $1. Imagine if it dropped $3.50, which is not difficult to do when you have oil over $100 a barrel. It can drop $3, $4, $5 in a day. Well, that's $3,500 on your $8,500 that you've lost. You're getting close to losing 50% of your money in a day because of just the sheer amount of leverage that you're taking on. Next, lack of transparency. So derivatives can add complexity to a product if you have what's called an embedded derivative within a product that you don't understand, or a portfolio that may not be well understood. The complexity, that is, may not be well understood. This is quite common for people who first start trading options. is they'll trade some options. Just put a little box with a number of options, and the price will begin to move, and they'll see that they're underwater here, so they'll trade other options to offset some of these, and the price moves, and they'll see they're still underwater. They'll trade another set of options over here, and they get to these very complex positions where if you say, well, if the price goes up $1, what do you think is going to happen? Well, I don't know. There's just way too many positions in way too many strike prices to figure it out anymore. It adds complexity very, very quickly. Basis risk. This is a divergence between the spot price and the forward or future price return. It's a divergence between the two returns. And this can happen for two reasons. The expiration of the derivative does not match the future date of the expected underlying transaction, or you have an imperfect hedge, such as using heating oil, which the ticker is HO, heating oil to hedge out jet fuel price risk, which is quite common because jet fuel has no futures contract. So heating oil is the closest thing correlated to it. So let's just look at a particular point in time at t equals 0. You'll have a spot price and a futures price, and in a normal market, wherever your spot price is, the front month futures price is usually above it, and all future months are above that. This is a curve called contango. If you have a spot market in stress, the spot market price will rise dramatically, and it will pull the curve like this. That's called backwardation. Don't worry too much about contango and backwardation. Just at time t equals 0, the futures and spot price will be different. On the day of expiration, because the futures price has no time left, remember the futures price at time t is a function of the spot price e to the RT. Well, on expiration day, this is 0. If this is 0, this whole term goes to 1. The futures price will equal the spot price on expiration date. They converge. But what if your contract has to end here because you have a transaction that has to be done and it has to end here? You don't have the transaction occurring here. Well, these two prices have not converged, so their returns may not converge. So you're going to have basis risk in the sense that if you thought you were hedging out 100% of your price risk, you find out that you might not have been. And of course, an imperfect hedge, even though over long periods of time there's a correlation between heating oil and jet fuel, in the intermediate and short term, correlations can diverge from a long-term relationship, and that'll create basis risk. Liquidity risk, good story on this one. Let's look at LME, London Metals Exchange, for nickel, the futures contract. It was sitting around 20,000 for a long period of time, and then overnight it just skyrocketed to over 100,000. And there was a Chinese producer who was short nickel futures. Well, you're short and the price is just screaming higher. However, this Chinese producer is a nickel producer and is able to deliver. But it doesn't matter. These are exchange traded, so they are marked to market every day. So this guy had to come up with billions of dollars overnight. Otherwise, his contracts would have been closed. And by the time he was ready to deliver the nickel, you might have had something do this, which means he was hedged. He lost all his money because of mark-to-market settlement. The price came down, and he delivers for 20,000 and just walks away with billions of dollars in losses because of this. So you need liquidity. You need to be able to meet the mark-to-market every day. So he had to get massive bank loans to meet the mark just to stay in the contracts. And the banks gave him the loans because they said, well, you got the nickel. You're clearly going to deliver the nickel. We know that. So you're not really going to lose, but you're going to lose today because you have to meet the mark-to-market settlement. But over time, when these two things converge, we can see that you're going to get all your money back. You've locked in a price. You cannot gain more than the price or lose more than the price. Okay, we'll lend you the money. But if he couldn't have arranged for all of those loans, billions overnight, you got to settle fast. If he couldn't have arranged for all of those loans, then those contracts would have been closed. What helped them on this one is after this happened, the LME shut down the contract and they shut down trading in nickel for about 5 days. Just shut it down. And they reversed a whole bunch of the trades that happened at these high prices because they should have had a circuit breaker that shut off somewhere over here. And they didn't. Next, you have counterparty credit risk. lower with exchange-traded derivatives, especially when contracts have price limits. They can only go up so much in a day and down so much in a day. Some may argue that counterparty credit risk is even non-existent with exchange-traded derivatives, but this is not always true. If we go back far enough, and I forget the year this happened in, I think it was either 2013 or 2014, the Swiss National Bank, SNB, was pegging the Swiss to the euro at 120 and didn't want it to go below 120. Well, one time in the middle of the night in North America, middle of the day over there, they said, you know what, we're not going to bother with the 120 anymore. Well, a whole bunch of trades had built up around the 120, and when that happened, it just went straight down. You woke up in the morning and you found out that and listen, it didn't move slow. It simply just went from here, and there was just, I shouldn't even draw a straight line. I'll do it this way. It was here at 120, and it just had a whole bunch of air, and it did this. This whole space in here, nothing traded. So when it finally started trading, when it finally caught some air, and exchanges were shutting down contracts because they exceeded their margin requirements, the margin was gone, and you had clients all over the world that now owed the broker money because, hey, listen, it got messed up. And there was one exchange, one trading platform that was down $400 million. After they cleaned out all their clients' accounts, kept all the margin, they were still short $400 million. They had to go to all these clients and say, hey, you owe us money. They ended up getting a bailout. They ended up telling their clients, don't worry about the 400. There was nothing that could be done about that, and it would have just been lawsuit after lawsuit and lawyer after lawyer. They said, let it go. They got a bailout to stay in business. But it could happen that exchange-traded derivatives move so much instantly that it wipes out everybody's margin everywhere. OTC is where you would have counterparty risk. But remember, there's a financial institution typically on the other side of each OTC contract. That financial institution's only going to do business with counterparties that it trusts. If it doesn't, it will ask for margin. These are commitments. Both sides have this risk on a commitment. So if you're, let's say, in a forward contract, well, both the buyer and the seller have counterparty risk, because if the buyer is in gains, there's counterparty risk that the seller is not going to meet the payment, and if the seller's in gains, there's counterparty risk that the other side won't make the payment. With contingencies, these are options. Only the long side has this risk, because if I sell you a call, I get paid upfront today. There is no condition under which you, as the buyer of the call, would ever owe me more money. I can never have counterparty risk from you, because there's never a situation where after you pay me the premium, you would ever owe me anything. But I may be in a situation where I owe you, so you are the only one with credit party risk. Only the long side has counterparty risk with contingencies. With commitments, both sides have this risk. Destabilization and systemic risk. Excessive risk-taking and leverage can create market stress when equity depletes and credit for margin calls dries up. This is 2008. Go back to 2008 and CDS's, credit default swaps. AIG was the big one there, wasn't it? An insurance company selling a whole bunch of CDSs, and they failed, and a lot of them had to be paid out. AIG simply just didn't have the money, but it was big enough that it caused ripple effects through the system and was big enough to take down the system. So excessive risk-taking and leverage, and we can use another word, concentrated in a few large entities that are nowadays classified as too big to fail. And because they're too big to fail, they are called SIFIs, systemically important financial enterprises. I think that's what it means, systemically important financial enterprises. And they have huge regulations about how much leverage that they can take and how much equity they need to back up the leverage that they're taking so that they do not create these big systemic events that spread throughout the economy. Okay, our next LOS here, compare the use of derivatives among issuers and investors. And let's be clear what we mean when we use the word issuers. We don't mean entities that issue the derivatives. We mean entities that issue financial securities such as stocks and bonds. It would have been better if it would have just said companies, especially non-financial companies. So when we see the word issuers, we really mean non-financial companies. And they will use derivatives primarily to hedge because they're not in business of trading derivatives. They use them in the course of their business, in the course of operations, so they will use them for hedging. Hedging asset values, hedging liabilities, and hedging revenues and expenses. So let's go through each one of these. When would we hedge asset values? Well, think of inventory. Think of a mining company that has copper in inventory before it sells it. Doesn't want to be subject to copper price fluctuation, so it may sell that copper forward. Another company may have a significant amount invested in marketable securities, cash on its balance sheet, and those marketable securities may have interest rate risk, so it might want to hedge out that interest rate risk. For liabilities, you could think of a company that has bonds, fixed rate bonds or floating rate bonds, and it would rather have a different type of interest rate risk rather than floating rate or fixed rate. Revenues, as we just said, for the company that was managing the value of its liabilities, when it does sell, that also manages its revenues. And expenses, if somebody is producing copper, let's say, obviously somebody needs copper, and somebody who needs copper doesn't want to be subject to huge price fluctuations, may lock in prices by using futures contracts. Issuers, and I make it clear here, companies must report all gains and losses on derivatives through the income statement, not into OCI, through the income statement, unless it qualifies for hedge accounting, which they primarily do. And if it does qualify for hedge accounting, it allows for offsetting. The dates and the notional amounts of the derivatives must closely match the features of the underlying transaction. So if you say it's a hedge, it better look like a hedge. So if you have, let's say, 2 tons of copper at the end of each month that you want to hedge out, but you are long oil contracts, CL, and claiming that that's a hedge against your copper, that's going to be kind of hard to make that case. But if you are matching your contract with the dates in and around the dates where you're going to deliver the copper, and the notional amount of the contracts matches the amount of copper you're delivering, there you go. There's a hedge. They will primarily use OTC derivatives because using exchange-traded derivatives to get the right dates and the right amounts are going to be difficult. But a mining company pretty much knows how much it can extract on a monthly basis within some variation, so it can sell a large part of that forward. Different types of hedges, cash flow hedges, absorb the variable cash flows of a floating rate asset or liability, or the price, a floating price of an asset or liability. Forex risk, interest rates, commodity prices, as we just talked about up here on asset values, the commodity prices that are sitting in inventory. Fair value hedges offset fluctuations in fair value of an asset or a liability. A received fixed pay floating swap increases duration against an existing bond issue. So a company that issues a bond, investors will hold that particular bond. Investors are long the bond. The company is inherently short the bond. Since the bond has duration, the company will have negative duration on that bond. If they want to bring that duration up to zero, that means not have that negative duration exposure, they can enter into a receive fixed pay floating swap. The receive fixed pay floating swap has positive duration, so you can increase the negative duration. And if you want to neutralize any interest rate risk, you would do so till you get a duration of zero. And number 3, we have a net investment hedge. Pay attention to the word net here. Offset the foreign exchange risk of the equity of a foreign operation. What is equity? Assets minus liability. It's the net of the two, which is where this gets its name. With hedges, if you're using hedge accounting with hedges, all gains and losses are held in OCI. They don't have to go to the income statement. They're held in OCI until the underlying transaction is recognized. So when the underlying transaction is recognized, if it's a loss that goes to the income statement, OCI would have the corresponding gain because, of course, you had a hedge, right? And they would then head to the income statement together. Issuers will use derivatives to offset or hedge exposures in their commercial or their financing activities versus investors, and we saw this on the first screen, allocation, right? That they use derivatives to gain an allocation to a particular risk, to hedge a certain risk, or to, what is it called, transfer a certain risk, or to manage or modify a certain risk. Replicate a cash strategy. I'm not trying to cross it out here. Replicate a cash strategy. Hedge financial risk or modify a risk exposure. For investors, retail investors, exclusively exchange-traded derivatives because they're just not at the size where a dealer is going to consider them a viable counterparty. Institutional, mix of exchange-traded derivatives and over-the-counter.